as a teenager in Brazil, a company called Pagar.me, which became one of the most prominent tech companies in Brazil. Like there are a few great tech companies in Brazil, and Pagar.me was one of the top ones. And he decided to move to the US with Pedro to attend Stanford after selling his company in Brazil. And right after a few months in Stanford, both Pedro and Henrique dropped out of Stanford to start a new company on what has become Brex, and the rest is history. So just let's start off with a little bit more about your experience at YC, and why did you both decide to move from your VR work beyond and to Brex, and what led you to this change, and what do you recommend other founders to do when starting a new company?
Yeah, happy to. So look, the story of the VR thing was we had this fintech in Brazil, and then we came to Silicon Valley, and we're like, we're never going to do fintech again. It's so hard. All these banks, it's so complicated. And we're now in Silicon Valley, like we're in the bleeding edge of technology. We want to do something really innovative and the really, So we thought about it, and we kind of got to VR. But then when we started working on it, we had what I think still today was kind of like a good idea, but we had no idea how to execute it. Like we literally had no idea where to start. We felt like when, you have like non-technical co-founders that have an app idea and they, are looking for a technical co-founder, and because otherwise they don't know what to do, we kind of felt like exactly like that for that business. So we gave up on it while at NYC. And then I think we got an advice that I thought was quite helpful to us, which was, hey, start a company that you as founders have some sort of competitive advantage to start. And obviously there's a lot of counter examples of this, but for us it was quite helpful because we started thinking, okay, like what do we know more than other people, And turns out we knew a lot about fintech and cards and payments, so we decided to try to think of something there. And then in Brazil, we were processing payments for merchants, and then we we're kind of paying them in their bank accounts. So we're like, okay, how do we how do we do more here? And we always had this idea of building a business bank account. And then we said, hey, why don't we do a business bank account? But it didn't seem like anyone was willing to give their money to these two random Brazilians that just arrived in Silicon Valley. So we decided to start up a card. We saw Nubank in Brazil doing super well, starting up a card. We're like, okay, that sounds like a better entry point. But we always had like a much broader vision. I think the few things that were super helpful for us back then is like, one, think about this framework of like building something that you as a founder that have a specific edge or more than other people about. And that's like, I think kind of like a good constraint, right, in the world of ideas. I think the second one that I found that was quite helpful in the process, like when exploring the idea, like kind of, I don't know, in our mind, we kind of modeled it out a little bit to see if it like could be a big business, right? And we kind of like got into the economics a little bit and try to find out if like it was a viable business. I know that goes contrary to a lot of advice, and a lot of companies weren't built this way, but at least for us, we found it to be helpful to try to be, and it also gives a lot more clarity because I think as second-time founders, we're like, okay, like our next thing kind of like needs to work, right? Like there's all these expectations, we're second-time founders, So we wanted to make sure that it was economically viable, whatever we wanted to do. And then the third thing was we went like, I would say what I called an average depth to validate the idea. We didn't go like super deep in every idea we tried out. Like there was a bunch between the VR and like Brex, like there was a bunch of them in the middle. I think I'll give you an example, right? Like we talked to we had this idea to build like hedge fund software, like a better alternative to Bloomberg. Like Bloomberg is like this huge company, and like, they seem very ugly, all this like black interface, and like just seemed like, I don't know, seemed right for disruption. So when we talked about it, and we saw a few opportunities how to make it marginally better, but we didn't find anything that was like, oh wow, like this is like a burning pain point. So we kind of like moved on from it. And I think there's a chance that with another strategy, we might have gone deeper into try to build an MVP and see if people would buy, and that would take months, you know. And I think in general, we just like went through we were the opinion of like, look, unless we find like a burning pain point, we're not going to do something that's just like moderately better. So probably those are a few of the learnings during that process.
Interesting. And how did you decide, like, how did you figure out the market was large enough?
So we always thought of ourselves as like more than just credit cards for startups, right? We always thought that was just like the entry point, and it seemed like business credit cards seemed like a big enough market. You know, there's like hundreds of billions of market cap there. So if we can win, and it's not like fake hundreds of billions, right? That like it's, hey, there's all these tangential things. Like there's actually like billions, you know, tens of billions in revenue or more, I think, generated just in business credit cards a year. So if we can win some share of that, that seemed like big enough. The question is like, can we find a value proposition, and can we build that value proposition to make it good enough for our customers?
Interesting. And it seems that you guys underwrite and take some risk. Like how do you underwrite and take on risk?
Yeah, the first version of it was quite simple. Was look, you raised $1 million, we'll give you 100,000. If you spend half of that money, your limit drops by half. If you raise more money, your limit grows. So it was kind of intuitive, you know, way to underwrite. That seemed very safe, but banks weren't doing it because they didn't have the systems to automatically do that. But I think the bigger point there is, I think a lot of people, they're afraid of going into businesses that require something that's not software. You know, a lot of engineers start businesses, they have this dream of going into a room and writing a piece of software and just putting it on the internet, and then everything like magically grows from there. And, you know, and obviously I have that dream too, right? Like that would be amazing. But I think a lot of the business opportunities is when you join software with something that's like a little bit different, like operations or credit, or, you know, any of these like non-easy things to do. And kind of like merged in with software. I think there's a lot of opportunity there.
Interesting. We might go back to that question because there are some questions from people in the audience regarding that, but let's move on to basically talk about fintech in general. What are the hot areas in fintech that you see right now in like B2C or in the B2B, in the business space? And you might go to specifics, but
I have an opinion on this. I think that niche stuff is a pretty good idea. So like, you know, there are 44 banks, so this is pre-COVID, so I don't know their exact number now, but like before COVID, there were 44 banks that were worth more than $10 billion each, right? So if you think about it, it's 44 companies that kind of do the same thing that are worth more than $10 billion. And the reason that is like, there's, you know, this bank that, you know, there's this bank called City National here in LA, and it banks all the celebrities and Hollywood stars and entertainment studios and all that. There's this bank called Arvis Bank in Arkansas, and they just bank the entire state of Arkansas. You know, there's a lot of like, I don't think it's going to be geographical anymore, but I think banking is still going to be somewhat niched for consumers, in which like, if you can create a, you know, an interesting value proposition together with some software or aggregating some other stuff for a niche, I think there's a good chance it'll work, because just a really big market. And so if you can win, I don't know, doctors plus nurses, you know, and you have some specific value proposition for them that's more interesting, and you have a broad set of products that can solve all their banking needs, I think that's a pretty good idea in my view.
Interesting. Let's move on to a little bit more about the differences that you saw in the fintech business in Brazil and in the US. So how is it different to run a fintech business in Brazil and in the US?
I think that like there's a lot more infrastructure in the US, so it's a lot easier to do stuff. So you can focus more on building product, recruiting, and all the important things about the business. in Brazil, there's just a lot of bureaucracy. So like it takes like a month and a half to get your company incorporated, and there's all these like stupid regulations that like getting internet like takes forever, renting an office, like everything takes forever. And then you just spend a lot of time on things that are not products and getting users and serving your customers. You just spend a lot of time on random stuff. So I think that's like one general business difference between that. I think a second difference is the regulations in Brazil are actually a bit more developed than the US. I think the regulations that were put in place for the US it was only for banks it's super strict because like you had the global financial crisis. So they kind of like overcorrected a little bit. In Brazil, the regulation was kind of born together with the fintech. So it's very fintech friendly compared to the US. So I think that's actually an opportunity, and that's quite cool. And I think the other very big difference, again, the big difference between Brazil and the US is like hiring people from other successful fintechs is quite helpful. So, our head of engineering came from Stripe, for example. They did a lot of mistakes and a lot of things right that we just get to copy, and we don't have to go through those mistakes. Our head of product came from Square, same thing there. Our CFO came from SoFi, lots of mistakes to learn from there. So I think you can just like skip a lot of the mistakes and get a lot of the advantages by hiring from these like successful fintech companies. Just don't hire out of Brex right now, but the rest of them you can definitely hire from.
Interesting. And you're talking about how you were able to hire these different people that already were trained in this space. How did remote change the hiring process, and how it affected the way the business run, and how is writing memos affected the business? Because I've seen that you guys change the culture to write more memos and make decisions based on that.
Yeah. So I don't know. It's hard for me to see a way to scale a company without a strong writing culture. It just seems so complicated. You would need so many meetings to like get everybody on board, and like. So I think that it was kind of like a necessary thing. I personally hate writing memos. Like it's one of the worst things I have to do in my job, and I don't have to do that much of it anymore. But like, it's not like I like doing it. My co-founder loves it, so he does a lot of it. A pleasure. But like, I personally don't like. But I definitely see the advantage of it because it's kind of memorialized forever. So like, people on board at Brex today, and we're sharing memos that we wrote like a year ago, and they're getting, oh my god, now I understand why these things are. Or if someone is curious about like, hey, why did we do this the way we did? They can find a decision, like a decision memo for that, and like, oh yeah, I understand the context for that now. So there's just so much happening in the company when it scales that I think it's impossible, not impossible, but it seems very hard to run it without a strong kind of like writing culture. And I think that it makes remote much easier if you have that, because the biggest thing about remote, so, it just came out 2 days ago, our engagement survey is an all-time high. The employees of Brex are the happiest they've ever been, the most engaged they've ever been in the history of Brex. And we're like, wow, like we're remote. Like, how did that happen? And the reality is like the only way you can do that with remote, in my view, is if you just don't have that many meetings. Because like no one likes being like 10 hours a day on Zoom calls. It sucks. And if you can just cut those meetings because you can have a memo and then people comment the memo and then the decision is made without having to hop everyone on Zoom, that makes your life much better in a remote world because you actually get more time to focus and do work and you feel more productive and all these advantages to it. So honestly, like when people ask us like, what's the secret for making remote work? I say just cut the meetings, just have less meetings. But it's not in a way that you're just making less decisions or you're delaying decisions. You're just making decisions asynchronously through memos or writing or any of these other ways, which takes some time to do right, but it removes kind of some of the mental energy. The other thing that's interesting about remote, there's this whole debate about can you build a company? Is it better to build a company remotely? Is it better to build a company in person? What would I do? And the conclusion that I got after a lot of time thinking about this is like, look, honestly, there will be big companies built either way. all in person, all remote. You just need to pick your set of pros and cons, like the cons of remote are the ones everyone knows. The pros are the one everyone knows. You just need to hey, what do you need to do to mitigate the cons, and how can you take the maximum advantage out of the pros? And I think that you just need to be okay with that, and and there's no perfect model, but there's also not one that's clearly going to be clearly better than the other, in my opinion. Both will be, I think, quite successful. So
interesting. Another question. You mentioned that you attracted I think someone that ran product for Square, the CFO of SoFi, and I think the head of engineering of Stripe, or someone like engineering manager of Stripe. How do you attract these awesome people and keep them at Brex?
Look, I think it's very important. I think there's a few things. So one is we actually try to understand what they want out of their next thing in their career, right? And make sure we give that to them. So, for a lot of these people, it's look, I saw everything that Stripe did right and wrong. I want the opportunity to do it my way. So I think that's number one, right? Is I think being flexible. One of the things that was the most counterintuitive to me is I spent most of my time trying to convince an executive that Brex was going to work. And I think that's definitely important. They definitely don't want to spend the time in a company that's not going to work. But it's important to spend just as much time convincing them that they're going to work at Brex, that they're not going to have a failed next step in their career. Because for an executive, the worst thing that can happen is they go to a company and it doesn't work out, and they're oh my God, this is the worst step I did in my company, and then they're hard to get another job, right? And all these things. So them convincing them that they're going to fit in your company, that they're going to be able to be successful, that you're going to give them autonomy, guys going to work well together, they're going to have the resources they need to be successful, is as important, if not more, than convincing them that the company is going to be successful. So I think that's, at least for me, that was not intuitive at all. It came with experience to learn it. And then the third thing is I'm very aggressive of executive comp. I'm hey, if you hire a head of engineering and he's amazing, he's worth whatever money you pay him, cash, stock, everything. We're extremely aggressive of executive pay. And if he doesn't work, there's cliffs. He can literally, you can fire him within a year, he leaves with nothing. The risk reward is so in favor of the founder that it makes no sense to lose an executive because of a percentage point, in my view at least. So. I hope our execs do very well for you because out of Brex, and the ones that didn't work out, they, didn't get anything. So it's kind of worth it in my view. We're super, super aggressive with this.
Interesting. I will switch to the questions from the audience. They have been filling up a little bit of a document, and the first question comes from Charlie. Charlie is asking what would be the next milestone pivot point of Brex, especially given how many companies are joining the fintech space, including companies like Mercury, Plaid, and others.
Yeah, so for us, I think the biggest milestone is we went from serving only tech companies. So until this month, if you try to sign up for Brex and you weren't a tech company, we'd say, nope, sorry, can't join. And it's not because we were mean and we didn't want customers, right? It's because all of our risk models and all of our stuff only worked in the context of tech. So we asked people who funded you? And that doesn't make sense for a restaurant in Omaha, right? So since this month, actually, now we just opened the floodgates so anyone can sign for Brex. And I think making that work, and scaling that is probably the biggest milestone for us.
Cool. I will go towards another question that's similar to this one. In this space, what's Brex competitive advantage or moat compared to other companies like Stripe or Ramp?
Yeah. I think it depends on the competitor, right? In general, I think the thing we spend a lot of time, and I think is one of Brex's biggest differentiation, is that We built 100% of our infrastructure from scratch. So we don't have any kind of like legacy technology that we rely on. And I think that's like a big advantage. So the reason like with, Brex Cash now, we can onboard customers instantly and, we can sign up anyone is like, it's because we basically build everything ourselves. If you relied on vendors, they have their own problems and you have to deal with that all the time. And it might not seem like that from the landing page, but when you start using it, you start running into a lot of limitations. You ask like, oh, why does this limitation exist? Like with your banks, right? Like sometimes you have some stupid stuff and you're like, why does my bank make me do this? It makes no sense. And the reason is they have this like really old tech and it's kind of how the way it works. Like, with, I know this story about Chase, for example, that at Chase, if a customer opened a credit card in a bank account separately, they couldn't link those two together. There was like no unique identifier to link those two accounts together. So, and things like this, our competitors may not be doing this, but the vendors that they're using may have some issues like this, and that kind of like transpose them. And for us, we've spent a lot of time building everything ourselves. So I think that's number one. Number two, around like people like Stripe, for example, that launch a competitive product. That's a big company, has like a lot of employees, they're doing payments. Like, we have like now 500 people just working on these like two products, right? So I think we just have a lot more resources working at building one thing or two things really well versus they're really good at their core business. And I'm sure if we try to get into their business, we do an okay job, but not great. So I think that's the second point. And yeah, I'll stop there.
Interesting. And related to risk and underwriting, this question is from Mary. What are some key lessons and insights that you learned from your experience with underwriting and risks? And like, what are the top signals that you use to decide?
Yeah, so the biggest insight is what is the intent that the customer is signing up for matters the most. So if you look at a lot of the successful fintechs, the intent in which the customers sign up is not necessarily lending. So like Square, for example, the intent in which the customer signs up is to get a POS. By the way, you can get a loan with Square Capital. Stripe, same thing. And the companies that don't trade super well, like if you get Lending Club as an example, the intent that they come to the company is to get a loan, and therefore like, it's more risky. So I think for us, what we try to do is like we try to have enough of a value proposition besides the credit, in which that's the reason people sign up. And if you can give them more credit later, that's great. But it's not the intent, because otherwise you have a negative selection bias of all the people who got approved from everywhere else come to you is like, okay, let me try this next, because I got rejected by everyone else. And then the pool of applicants that you're getting for your lending product is the most important thing. And the risk in the end, the top of the funnel actually is the biggest influence, and the bottom of the funnel losses, it's very rarely something you do in the middle.
Interesting. And now shifting a little bit, this question comes from Paul, who knows a little bit more about fintech. I remember that you mentioned at some point that you guys were trying to get a bank charter and it was really hard. And it seems that there might be some challenges with regulations. What regulations do you foresee that could challenge your ability to keep growing or innovating in the fintech space and with new products? And what are regulatory changes that could actually help you in the future?
Yeah, so look, the regulations the thing that the government is trying to regulate a bank, like if you just ask why are banks regulated, right? If you just ask that like more basic questions. Banks are regulated because they take deposits and they lend out money. If banks only did payments and they were like just like making payments there and forward, there would be some regulation because of money laundering, but not as much because they can't lose like customers' money by doing bad loans. So the more we go into more aggressive lending, the more being a bank or dealing well with the regulation matters. The more we go away from pure lending and we do other things like software and payments and rewards and all these things, the less these things end up mattering. But lending is a great business, and taking deposits to lend, amazing business. I would love to do more of that if we could, if we were a bank. But the regulations that they impose on banks today to do that are really, really high. So just to give you guys an example, if you're going to start a bank today, you need to have enough capital right now to fund, for new banks now, 15 to 20% of all the new loan originations that you have for the next 3 years, right? So let's say you're originating $1 billion of loans, you need to have day one, 200 million. Like, that's really hard to do, especially at any meaningful scale. So, and $1 billion in loans is not that much. Like, it's actually very little if you look at some of the volumes you need to have a big business. So it's quite hard to do that today. I think that if there were to be regulations that made that easier and smaller scale, and say, hey, look, you can start out, you can test stuff out, you can run, lean for a few months or like until a certain size, and then they kind of like gradually increase the regulation on you. I think that would be super helpful for fintechs.
Interesting. Another question is related to fintech. There's a saying that opportunities in fintech revolve around some team of building a better mousetrap. How would you respond to that statement? Do you believe it's true?
Can you repeat it?
The most of opportunities of fintech, there's a statement that says that most of opportunities in fintech revolve around the team of building a better mousetrap. Like basically to catch the mouse. That was a question from Paul. I don't know if Paul wants to comment on it.
That would be helpful. I don't think I understand what the person who had the expression wanted to mean. So
let me try and do that justice. I guess I'm trying to understand it's a statement, true or false, or how would you respond to it, that a lot of the stuff within the realms of regulatory, what's allowed regulatorily. I guess another way to frame it is like, how much innovation do you see left in the space when it's hampered by regulation?
I think that in some ways, it hurts innovation, right? Because really it's hard to start a fintech. But in the end of the day, it's hurting consumers and businesses, I think, more because, honestly, we have really good margins. And the reason we have really good margins is kind of hard to start a business like Brex because there is regulation. And if it was much easier, more people would be competing with us, and then our margins would go down. And then it would be a better deal for businesses and consumers. So I think in one way they're protecting consumers, which, is great. But on the other hand, like, it is, I think, preventing prices and things and margins to contract because it is kind of a barrier of entry, which honestly for me, I love that there's regulation in fintech, because it's so hard to compete with us, so hard to build our business that we can have differentiated margins for a long time. Versus if it was like easy to build a competitor, we would probably be competed out pretty quickly. So that would be bad for us.
And the last question from Paul, what are the areas where you think the next batch of innovative companies' products will come from? So one area that we could talk about is, for example, DeFi in crypto, like, for example, Compound and other DeFi protocols like that.
I think that there are some use cases in which it makes a lot of sense. I think especially international payments, I think that, the way people do this today is through SWIFT, which is like really, really, really bad. So any kind of like better international, I think that's a big thing that still is not solved. But I think anything around local payments, honestly, it kind of works, right? Like if you look at China, it's better, but like it's not that much better that US consumers are willing to adopt it, but it's a lot better than cash. So I think that I think it's more applicable in schemes in which the payment are really hard and not just making it like marginally better, if that makes sense. for all of the payments context, like there's all these storing value and all these other applications, right, which are different.
Yeah, I don't know if you've seen, but there was, I think, the approval of USDOC, as so you could use stablecoins for selling payments now. I think that, yeah. Anyway.
Yeah, I saw something like that. I didn't dive into it though.
Yeah. So another question is related to your big ad push, the billboards. And I think I've heard your CFO talking about it, bringing from SoFi to Brex. So what led you to go for such a big ad push? And what geos did you target? And was it a success?
Yeah, so I think the way we think about marketing is a little bit more fundamental, right? I think that, paid marketing is amazing, right? Don't take me wrong. But at the end of the day, before paid marketing, programmatic, Google and Facebook ads work, how do people do it? It was a funnel in which hey, you need qualified customers to see your ad enough times, and eventually they're going to go to your business and check it out, right? That's kind of how the funnel went, and you got preference over time. It's all about repetition. And I think thinking from that point is turns out that we were targeting startups. The most amount of startup founders are in San Francisco, and those billboards are priced. Basically as if you were a regular customer. Were at the time. Now maybe it's changed. That could be seeing a beer ad or it could be seeing a Brex ad, but on average, that person seeing the ad is a lot more valuable to us than it is to a beer company. So we just arbitraged that and just bought all of the billboards we could for 3 months, which wasn't that expensive at the time. It was $300K, which obviously a lot of money, but not for in the context of a company's advertising spend. And it worked out really well. And then everyone started copying it because I talked too much about it. And then now it's super cheap again because no one's walking, but maybe it's a good time to lock in some long-term contracts there.
Interesting. Cool. Maybe it's related to that. I will go to this question. What inspired you to buy South Park Cafe? Is that related to marketing?
Yeah, so I think the first part is we wanted the floor on top of South Park Cafe because that was our Brex lounge to kind of make a cool experience to compete with the Amex lounge, And we saw Capital One having some success with it and ING Direct having some success with it. So we decided to try it out. So that was one of the reasons. The second thing was we wanted to we thought that we were going to go to restaurants next. That was one of the verticals we were considering and targeting next. Now we're a lot less verticalized than we were before, but at the time we were, and we really wanted to see how a restaurant operated, right? And firsthand, what are the problems? What are the opportunities? So I kind of joined both things, and ended up, looking back, was it worth it? Probably not. It closed in 5 months because of COVID. And we had a 2-year lease, so we paid a lot of money that we didn't get back, and it took a year more to build than we thought it would, and it was twice as expensive. So, or to do it again when I do it, no. But some of these you get right, some of these you get wrong, right?
Interesting. Cool. A question regarding credit cards and startups. Are credit cards the future for purchasing for startups? And are there new ways coming up to pay invoices for services with decreased fees?
So the thing about credit cards is the reason the fees are as they are is because consumers love points. In the end of the day, that's kind of what it makes it as it is decreasing points is not a super popular decision in America because you have a bunch of people who don't really care, and then you have a minority of people, which all of you probably know, one of your friends who a rewards obsessed person who catches miles and all these cards and accumulates them and has 17 different credit cards, right? Probably everyone knows someone like this. And those people are very vocal about, protecting that. So I think that's something interesting. It's just the incumbency. So I actually think credit cards are going to increase penetration on payments, especially as we go to higher margin business, because if you're selling software at $100, you don't care if you pay 3%, and now have $97. It's more of a problem in like retail, in which we're selling something for $100 and you get like 5. That's kind of a problem to pay 3 as a fee. But like for super high margin businesses, which are more the businesses that are being created in Silicon Valley, it's not really that much of a problem.
Interesting. Talking about lending, what are your thoughts on e-commerce lending players like Stripe Capital, ClearBank, and maybe Affirm?
So what about them? Sorry.
Yeah, what are your thoughts? Just general. That was a question from Freeman.
I think that, look, traditionally, pure lending businesses have traded poorly in the public markets, right? And there's 2 reasons for that. The first reason is, the beauty about software is kind of what I was saying is you build something online, and for every incremental customer, there's not really a cost, right? You can you sell copies of your software or, subscriptions or whatever infinitely. It's not true for lending. A lot of times, the more you grow, the more money you have to put. So you don't reach that point in which you don't have to put more money to grow more, which what makes software has so many great multiples. So that's one point. The second point is whenever there's a recession, in thesis, a lot of the equity in the profits you had over a long period of time, you get wiped out and all in 1 year. So you don't really know that. So usually that's why, lending companies trade at a discount. Affirm solved this in a pretty clever way. So the way they did it is, hey, the merchant has to pay some sort of fee to just accept that kind of payment. And that is independent of the performance of the loan. So they actually don't need to put more money to keep that going. And they also get customers for really cheap. So the lending is very profitable because you don't have to pay the CAC to acquire that customer, because the business is basically the business is paying to generate customers for a firm, which is quite a smart model, right? So I think that's why they're kind of trading where they are. They're just not a traditional lending business. The other 2 is TBD, right? I'm not an investor, so I can't predict that much if they're going to work or not work. Affirm's the only one that's clearly working, so let's see how they do.
Cool. Going back to your YC days and the different ideas that you guys thought about, do you guys hear any signals or anything that about why the next generation Bloomberg was not a significant pain point, or was just that Brex was a better fit for you guys?
Yeah, so this was quite surprising. It turns out the biggest value of Bloomberg is the chat. There's this chat that people get to close trillions of dollars a year in transactions through a chat in Bloomberg. That the entire finance market is connected. So it actually has really strong network effects, really, really strong network effects. So we're look, that's, no matter if we built everything else better, just that is a reason to not enough to switch,
Oh, that's very interesting. Going back a little bit to Brex and the culture that you have, how have you thought about shaping Brex culture and processes? And anything particular unique compared to other tech startups?
So I think that the probably more unique thing is Brex has our first value is dream big, which we copied for some Brazilians, but it's very core to what we do. I think at Brex everything that we do, we start with the dream big, what is the best we could do, right? What is the most, what would the best experience look like? What's the best person we could recruit in the world? And we kind of start there, and a lot of times it doesn't work, but then we kind of climb backwards and try to adjust. But if you just aim really high, you end up achieving a lot higher. And I think that's pretty built into our culture. So I think that's one thing. And then I think that's pretty unique. I think the other thing that's really unique is I think our leaders are really good at details and management at the same time. I think we did a really good job filtering for both of these things. So both people who can are good leaders and can manage, but also dives into the details and solve problems and take ownership. So I think those are two things that are pretty cool about our culture. I can talk a lot more, but that would be a Brex recruiting event,
That would be nice. There are a bunch of talented people at SPC. Probably the most talented group here in San Francisco and in the globe. It was the essay that Pedro wrote on the Medium on your page, on your Medium page, was super nice. Could you talk a little bit more about what led the decision for you both becoming co-CEOs and how that's working? He mentions that, Pedro mentions that in that post, if you guys want to read afterwards.
Yeah, so it turns out we're just super complementary in terms of skill set and likes, right? So I'll give an example. I'm enjoying doing this. I like coming here and talking to you guys, sharing some of the knowledge, and maybe it turns out something good for Brex, maybe it doesn't, I don't really care. Pedro would hate doing this, he was like, why am I doing this? I have work to do, let's go. On the other hand, I particularly hate writing memos, as I told you guys before. It's really hard for me. I'm not a great writer. English is still hard for me, especially in written format. And Pedro loves doing them. He loves writing memos, he's spends 5 hours doing it, and he's like, oh my God, I just wrote this amazing memo. I have no idea. So I think we just have different things that we like doing, and they're very complementary and good for the business. So I do all the fundraising, all the PR, all the business development and meeting people and customers, and bring a lot of the outside knowledge into Brex, meeting advisors, investment stuff. And he does a lot of running the day-to-day operations internally, and I'm the external CEO, he's the internal CEO, and that's kind of how we divide things up, and it works really, really well for us. I think that the co-CEO structure that doesn't really work is when you have half of the company reporting to one person and the other half reporting to the other person. I think that's really hard to make it work, because in the end of the day, you need one person that's gonna trade off stuff, and just make the hard decisions between, should we ship this faster to grow faster, or should we, pay up some tech debt, right? Or these kind of day-to-day decisions that are cross-functional. It's really hard to do if you don't have one single decision maker there. So I think that's a little bit tougher to make work.
How does the reporting structure work with both of you?
So no one reports to me. Everyone reports to Pedro, which is my dream. I don't really like managing people. And so it's awesome, and look, obviously all the big decisions we make together, but all the day-to-day decisions he can easily just make with the team, and it works super well.
Interesting. So apparently a common tactic for fintech startups is to use full stack services like banking as a service, card issuing as a service. My understanding is that Brex was its own issuing processor from early on. How did you get the card networks and banks to work with you as an nascent startup? That was a question from Kyle.
Okay, great question. This was one of the hardest things to do. So basically our trick was, traditionally the way other startups have been doing is that they've been going to banks who already been doing a lot of these things and try to convince them to do. But there were a lot of problems at the time of that, of the banks didn't really want to do it, and they had to approve all your marketing. They had all these control clauses. So what we did is we're okay, so how do we go to a bank that has never done this before? And if they agree on doing it, they have no idea what they're doing, so we can actually get away with all the stuff we want. So that's kind of how we did it, and it turned out to be amazing for our partner bank. They made tons of money with us, and we got all the control and all the deal things we needed to make Brex successful. So that's kind of how we thought about it early on. And then we were always obsessed about building our own infrastructure. So okay, we may start using some processor to process MasterCard, but the core ledger, that's all going to be within Brex. The core servicing, the collections, a lot of these things there are things that are hard to switch layer. That's all going to be built internally. And it took a year plus for us to launch publicly because of that, but I think it was worth it. Even though it took a year for us to launch, though, we were transacting in 3 months since we launched, which allowed us to get a lot of feedback on product market fit. And then we use like, I think Marquette at the time, that made it super easy to start.
Oh, wow. Cool. Talking a little bit more about the general state of fintech, you mentioned that banks might move to more a niche kind of business, kind of like what we saw in media in the last 10 years. What do you think is going to be like the old banks' next move? And do you think they're going to keep running brick and mortar locations? And what's the next move for old banks?
I think they're going to service better and invest more in retaining their best, most profitable customers. So, you know, affluent white people in their 50s are going to probably be very well treated, you know, because that's where a lot of they make their money. And I think they're going to not care too much or try to make some failed efforts into the, you know, the next generation, the next set of businesses, the next set of consumers. They're going to be a lot more protective about their existing base and try to win the new base, which is going to be the consumers of the future. So I think that like they're just going to be really protective of their core market to try to like not lose, and that will actually create the biggest opportunity because there's all these people and companies being left at the edges.
I see. And do you think there's opportunity for you guys to get?
Well, it is an opportunity, right? So the way we pitch ourselves, like we're serving the next generation of businesses, right? So if you're like a profitable manufacturer in the Midwest with 30 million in profits every year, you can get like pretty good service from a bank, right? But you know, startups, new businesses, e-commerce, cloud kitchens, like all these new business models, they're actually like pretty underserved and they have pretty different needs than traditional companies.
Interesting. This question comes from Ina. She mentions that the way people use their finances it seems to be cultural, a little bit cultural, based on their habits, and they rely in different banks and credits, and that's basically cultural. Do you see your products being outside the US? I know US is already a huge market, but do you guys have a plan to go outside the US? And
I think we have aspirations, we don't have plans. So, you know, our product surface is pretty big in the US, so we're pretty focused on winning it here. And then whenever we have a little bit more time to breathe, we'll probably go international. But I think we're more focused on building more products and go to more markets here in the US than trying to do the same thing internationally. Not because we don't think these markets are big, it's just the effort reward is really hard.
interesting. Talking a little bit more about Brex business, do you have any plans of giving that to very young companies? Some sort of like they mention like a super junk bond, or are you guys just focusing like in a different market?
I don't understand the question, sorry.
The question is, would Brex consider give that to very young companies, like super young companies that are basically pre-seed?
Give what, credit, you mean, or?
Yeah.
It looks like Noah asked it too, if Noah wants to maybe step in and, okay.
Yeah, so it makes sense to give corporate credit to young companies. There are sort of public companies that can get investment grade bonds all the way down to junk bonds. Maybe there's room to push that to even younger, even riskier companies as another vehicle for sort of raising debt. I don't know if that even makes sense. Feel free to...
we're definitely looking into opportunities like this. I think like some of the ideas, I think there's a company called Pipe and Capchase have been somewhat doing this with like subscriptions. I think that debt for like not super early stage, not like pre-seed, but like companies that have like some sort of traction, but they're far from profitable. I think that's like a big opportunity because people use equity for all of it. And I think it's not as risky as everyone thinks for some companies.
Cool. One last question. So how did you go about raising your first debt vehicle?
Yeah, so, you know, ironically, we raised it at Silicon Valley Bank. And I think it was important for us to get the bank partnership that I said at that bank. It was important that they knew that we had debt. It was kind of like a chicken and egg thing. Like the bank only wanted to give us a deal if we had debt. The debt only wanted to give us a deal if we had the bank. So we kind of needed to, hey, I have a term sheet from these banks, but I want to see your debt first, and kind of like vice versa. But honestly, the way you do it is they're going to give you a very small line, and you have to give some warrants, and that's it. You just deal with it. The other guy on the side knows you have debt and knows you've gone through the process, and your next time will be cheaper and easier. But don't give too many warrants. I remember we got some term sheets asking for like 3% of the business or something. Don't do that. Just get a smaller size and less warrants than like something larger with more warrants.
And I think we'll end with this. I want to thank you. Thanks everyone for the questions and for participating in this conversation. I don't know if Ashley or Ruchi want to say something before we end.
Yeah, thank you so much, Giuliano, for moderating, and for Henrique for coming back a second time to SCC. And yeah, thank you. We hope to have you back again. We won't make you work as hard next time. Maybe you can come and watch an event next time.
Thank you so much. I love doing it, and see you next time.
Good. All right. Bye, Henrique. Bye, everyone.
Bye-bye.
Thank you. Bye.